Hi everyone. So sorry I can't join you today. I'm really sad I can't hear everyone's presentations, but unfortunately I just couldn't make it today, so I'm recording this and I hope you enjoy learning about my topic, which is revenue bonds and public transit. So here's our presentation for today, what I'm gonna be talking about. I'm gonna give you a quick bond explainer, review a few things that we talked about in class, and then also talk about COVID-19 and transit ridership. I'm going to be looking at the financial health of two specific transit systems, and then I'm going to spin it forward and talk about why do we even care about this. So, what are bonds? We talked about it in class, but again, I wanted to review it. So bonds are debt securities, also known as fixed income securities. They're financial instruments that have defined terms between a borrower and a lender. So it's essentially a loan. You're paying back someone with interest over time. I give you some money today, and that money today is going to be worth more in a year from now. So you pay me back a little bit of interest over that time, and then you pay me back that money in full in a year from now. It's essentially the time value of money premise that we reviewed in class plenty. So I hope you guys remember that. There are many different forms of bonds, including corporate bonds. So, we talked a lot about municipal bonds, but there's also plenty of corporate bonds. There's different financial instruments out there in the marketplace. So, getting more specific, what are municipal bonds? So municipal bonds are debt obligations issued by a state, local, or other special government. The one we think about a lot is school districts. The school districts raising money to build a new building. We also have special improvement districts for downtown central business districts to, provide ways for people to come to the business district and make it more beautiful. They fund capital projects and infrastructure that cannot be paid for in one budget cycle. So it's that thing we talked about, intergenerational equity. It doesn't make sense for a government agency to be able to save up and pay for a big project in 1 year. Just like you don't buy a house with all the money you saved up over your lifetime, that would take a really long time. You go and get a loan. You can't do this in one fell swoop. So that's the idea of municipal bonds. We have a big project. We want to get it done. It's an investment for the future. And so we're going to go borrow the money to make it happen. So municipal bonds exist in two different forms, general obligation and revenue. So just to give you a quick idea of how much money is out there, how many municipal agencies owe money, at the end of Q3 in 2023, there was $4 trillion outstanding in municipalities, in municipal bonds. So again, getting more specific now that we know what municipal bonds are. We have two different major categories within municipal bonds. We have general obligation bonds. We won't spend too much time talking about that, but they're written with the full faith and credit of a government, meaning that the government has to do essentially whatever it takes to pay back this money. They will raise taxes, they will sell off equipment, they will do whatever it takes to pay this bond back. They do not want to default and have the town go bankrupt. But what we're going to focus on today, because it's more specific to my project, is revenue bonds. This is money that's going to be paid back from a specific project. It's going to fund a specific project, and the money to pay it back is going to come from that specific project, most likely. And just to give you an idea, some revenue bonds are non-recourse, meaning that if the revenue source dries up, the bondholder does not have any underlying claim. So say a transit agency goes bust. Everyone decides, I'm tired of riding the bus, I'm going to drive everywhere now. There's no more riders. That So they are now in default and they have to shut down. If they issued non-recourse revenue bonds, that means too bad, the people who bought the bonds are just out of luck. So there are many different types of municipal bonds. Like a lot of the financial world, it's very complicated and gets very into obscure different kinds of purposes. So we talked about, I believe, zero coupon bonds. That means you're not paying any interest. There's also other kinds of bonds that can be mixed and matched. So you can have an insured bond, that's also a zero coupon bond, that's also a municipal note. Municipal notes are essentially short-term loans, short-term bonds that they mature in less than 1 year. And again, these bonds, they come in different kinds, and they help municipalities, states, government agencies get the projects done that they want to get done. So again, coming back to revenue bonds. Revenue bonds comprise of most of the municipal bond market, and transportation revenue bonds are the most common type of revenue bond. So just to give you an example, so what is a transportation revenue bond? So let's picture a city. The city has an airport and it has a central business district 5 miles away from that airport. So the government, the local officials, government officials, the transit agency officials come together and say, you know what, let's build a rail line from the airport to the central business district that will help passengers get to where they want to go. Let's expand service. We think it's a good idea. It's going to help reduce congestion on the highways. It's going to help the city be more appealing, so when people fly in, it's easy to move around. So the transit agency and the city will create the revenue bond to build the line, and then they will pay back the interest and the principal, which means the amount that was loaned, with fares generated from all the people that are using the rail line for service to get to the central business district instead of taxis. So, like I said, transportation revenue bonds make up most of the municipal bond market. So I found this super helpful chart from Bloomberg, the Municipal Bond Index. And so as you can see, most of the municipal bond market is made up with revenue bonds, and within that, most of it is transportation, followed by water and sewer, and then special tax. But also, municipal bonds, revenue bonds do other good things. They help build hospitals. They help build schools. So, explaining revenue bonds some more, just to give you a lot of details on revenue bonds. Usually they have long maturity cycles between 20 and 30 years. They can be in various increments, but I found out the most common one is between $1,000 and $5,000, excuse me. And they can also have serial bonds, which means they mature over different dates. So that they have, when a transit agency or a government agency issues a serial bond, a serial revenue bond, that doesn't mean all the money is due all at once. They pay back the principal over a different year. So in 2024, they pay back a certain amount, 2025, so on and so on. And just to let you know, this is a fun fact, you guys probably realize this, but I'll tell you anyway. Today, as a retail investor, you can invest in municipal bonds. You don't have to have $1,000. We're all grad students. Probably a lot of people don't have $1,000 just sitting around saying, I want to invest this, but I don't know on what. Today, as a retail investor, you can open a brokerage account in like a Fidelity or a Vanguard, and you can be an investor in the municipal bond market with index funds and other derivatives of the municipal bond market. So I believe we should put our money where our mouth is. Just kidding. So transportation revenue bonds. So bonds, and specifically revenue bonds, are a fundamental way that new infrastructure projects happen. Revenue from these new projects are essential to paying back the bonds, but a lot of projects for transportation agencies, like I talked about in my example, they couldn't happen without revenue bonds. There's two different kinds of transportation revenue bonds, so we're keep getting more and more narrow, more and more narrow. There's two different kinds, including toll-backed revenue bonds, so those are pretty straightforward. They fund roads and highways, and the money to pay them back comes from the tolls. Your little Easy Pass transponder, you're helping pay back an investor when that happens, amongst other things. Those are pretty good investments. Investors seem to really like those because America loves driving. There's also fare box revenue bonds, so that these are a little more complicated. These fund public transportation projects. So fare box revenue bonds, they can be issued, but they come with some stipulations. The Federal Transit Administration says you really shouldn't be issuing fare box revenue bonds unless you hit these criteria. And a lot of it is that a government agency, like a local or state agency, must commit to fund that transportation agency more for the next 3 years than they did for the last 3 years. So essentially, the federal government is saying you can't let your transit agencies issue a bunch of debt, essentially be financially irresponsible, and then you can't support them. You have to be able to help them out. You have to provide funding for them. So to go to my first bullet point, fare box revenue bonds, they're a pledge to collect revenue from the operating transit system. But as you guys may or may not know, most transit agencies in the country aren't fully funded with the fares that come in from the passengers. New Jersey Transit is an example. It's called the fare box recovery ratio. It varies by system, but New Jersey Transit for 2019, before COVID, it was 22%. So for every dollar NJ Transit spent, only 22 cents was paid back by me or you buying a ticket. Other funding sources came from taxes, from the federal government, from the state government, from grants of different kinds. So if agencies are issuing all this debt, but they can't really even pay for the day-to-day operations, what are they to do? How are they going to issue these bonds? Because they certainly can't issue them to fund day-to-day operations. Again, that's an FTA rule. That's a guideline. I don't believe it's in anything legal. There's no law against it, but I think a transit agency is less likely to receive more funding from the Federal Transit Administration if they use fare box revenue bonds to fund day-to-day operations. And again, when fare box revenue bonds are written, usually they require a gross revenue pledge to debt service of 3 to 4 times. So that means that when they're going out into the market and they say we want to write some bonds, we want to get some money to do a project, the underwriters will say, okay, that makes sense. You want to do this project. How much money do you guys make? Okay, we make this amount of money and we cover this amount of our operations. So they use that and calculate, okay, we can only loan you a third of what that is in a year because we don't want you to be too in debt. So I'm going to talk about 2 specific agencies. SEPTA, which services Philadelphia, and the MTA. So I chose both of these systems to do a comparison because they have a lot in common, but they're also a little bit different. So they're both legacy systems, which means at one point they were run by private companies. So a lot of the infrastructure, the lines, the stations for both of these agencies were built by private companies before those private companies went bankrupt and they were taken over by government agencies. They also serve extremely large metropolitan areas. They're 2 of the oldest cities in the country and they have a lot of aging infrastructure. They're also both very large. As you guys would imagine, the MTA is the largest transit agency in the country by a fair bit, and Philadelphia is number 6. Just to give you some perspective, the fare box recovery ratio for the MTA is 33%, and for SEPTA it was 31%. Both of those were in 2019. So just to give you an idea, this is the pre-COVID financial picture of both of these systems. SEPTA relies on not just fares, as I just said, they only get roughly 30% of their funding from the fare, 30% of their revenue from fares, and they have to rely on other funding sources, including the Pennsylvania Turnpike Commission. And this is something interesting I found out, that the Turnpike Commission, because of a law passed by the Pennsylvania state legislature, they are required to give SEPTA a certain amount of money each year. But right now, the Turnpike Commission doesn't have that money sitting around either. So they would issue bonds, municipal bonds, and then pay that money to SEPTA. They would transfer that money over. Even with these other funding sources, SEPTA before COVID was in debt for $2.54 billion. And just to give you an idea, they lost $1.1 billion just from operating the system every day in 2019. The MTA, again, a much larger system. It relies on a lot of funding sources as well. I looked at a chart that shows all the different kinds of funding sources, but it includes many different kinds of taxes, many different kinds of tolls, and of course fares. And just to give you an idea, the total debt for 2019 was $35 billion, and $10 billion of that debt was issued between 2015 and 2019. So we know these government agencies have a lot of debt. They don't have a lot of money to even run the system day to day. So what happens when all the riders leave? So this is a snapshot from the SEPTA ridership recovery dashboard. This is their October 2023 numbers. This is the latest they had versus what the ridership was before COVID. So as you can see, ridership has recovered almost just in half. So they are running the same amount of system, they're running the same amount of buses, they're running the same amount of trains, but one of those funding sources was greatly impacted with COVID. This is a snapshot from the MTA. As you can see, roughly just over 4 million people were riding the subway every day before COVID. Those numbers have climbed back up, but as you can see, the daily average ridership is still hovering just above 3 million. So that's 1 million people not swiping, not paying $2.75 to get on the subway every day. So what happens when these transit agencies say, we're running a huge deficit, we have all this money due, what are we going to do? We need help. And this is where the federal government comes in. Many transit agencies got COVID support through the pandemic, including a couple different pieces of legislation. The MTA, the latest I could figure out is that across different pieces of time from the Trump administration and the Biden administration, they received roughly $14 billion in aid from the federal government. SEPTA also received $252 million and $96 million from different pieces of legislation as well. And as we know, the federal government, they don't have that money in either. They're in a deficit as well. So essentially, one agency is borrowing and handing it over to another agency. But they have to. If they're going to pay back these bonds and they have no riders, what are they going to do? Is the federal government just going to let two of the largest transit agencies in the country just stop operating and let the lenders come and take away the trains? No, that's not going to happen. But what happens when the system has a huge deficit and things have to change? The path is not sustainable. So outside of refinancing, transit agencies, as we know, have to pay back their bonds. It's a legal obligation. So they continually refinance and add new debt and hope that new revenue systems come in, like higher taxes, or they can raise fares, which is, lowers ridership. But also it can mean that there's cut to service. They have to cut the amount of drivers. They have to reduce the scheduled maintenance that they have. That also means that they have to cancel projects, and even projects that are shovel ready to go. They have to cancel them, and they're driving towards a fiscal cliff, which means they can keep borrowing for now, but if they don't do anything, they're going to have to do all these drastic things that hurt riders in the long run. So, looking at today's outlook, I was pleasantly surprised to see that despite the financial issues, both of these transit systems have A and A minus ratings from the different credit rating agencies. So all in all, municipal bonds, even from cash-strapped transit agencies, are still a good investment for investors out there in the greater financial world, which is good. That means they're paying lower interest rates than they could, which means less money to pay back and less likelihood that they cut service for us riders. So after COVID, what are they going to do now? So the MTA, they really have pulled back from the immediate fiscal cliff. There's been some policy changes, including a payroll mobility tax. There's been toll increases. They have announced that fares will continue to increase. They're a little more quicker to do that than SEPTA. And congestion pricing, as we've talked about in class, a big deal. That's going to generate a lot of money to pay back debt and have the MTA be more fiscally solvent. But really, building back ridership is key to building back ridership, to pre-COVID levels is the key to long-term financial success. Even though they're not driving to the fiscal cliff with these policy changes, there's still a large amount of debt. As I said, there was $35 billion in 2019. Now they have $48 billion. So really, that amount of money still needs to be addressed. SEPTA, unfortunately, the situation isn't as bright in the immediate term. They are still driving towards that fiscal cliff, and they have not seen the funding sources committed for the short to mid-term like the MTA has. Right now, analysts are projecting that they'll have to raise fares. They have a very low fare in Philadelphia. It's $2 compared to $2.75 in New York. But they will have to raise fares and then also cut service. They need to find new ways to service the system through money. So why should we care? Okay, that's great, but what does it matter? So I'm going to say it, and I think most of you guys would agree with me, that public transit agencies are the lifeblood of our cities. We need public transit for a city to work. For every dollar spent at the fare box, there's $5 of economic return to the greater regional economy. So, when you ride public transit, you're saving money and spending it elsewhere. You're not taking a taxi. You're taking that money and buying coffee at a local shop. You're doing other things with your money that are generating more economic investment. And public transit is better for our lungs, our urban lands, and our planet. And if we don't invest in it and support it, then we all suffer for it. Thank you guys so much for a great semester. If you have any questions or comments, please feel free to email me. Thanks.